Welcome to the Dealmakers Podcast. The Dealmakers is a platform for leaders in the commercial real estate industry to share their personal stories, business insights, and industry secrets because we believe in spotlighting the real people behind the deals. This podcast is brought to you by Agora, a comprehensive real estate investment management platform offering a wide range of services to enable real growth and provide the best real estate investment experience both for GPs and LPs. I'm Asaf Raz. Let's go. And today with me, I have a very special guest, and he's also in a very interesting vertical right now that is really up and coming, and it's making waves in the industry. Sean O'Dowd, he's the managing partner at Scholastic Capital. He's been focusing mostly on single-family homes and elite school districts, but he's going to tell us more because I'm not the pro in this. So Sean, please take it away. Tell us about yourself. What do you do today? And we'll take it from there.
Yeah, for sure. Thanks so much for having me. So like you said, I'm managing partner of Scholastic Capital. We buy single family homes in high-end school districts, and then we rent them out on long-term leases, typically to families who want to be in that really good school district for their kids' benefit. So it's kind of a very interesting flavor of SFR where it's a very high demand asset. A lot of people want to be in there in the school districts, and then very limited supply because these great school districts tend to not have any available rentals. And it kind of creates a really interesting result for our investors.
Super cool. So how long have you been doing this? How long have you been in the market?
Yeah, it depends on where you count the start. So I started doing this with my own capital about 5 years ago. And then we turned it into a fund about 2 years ago. Okay.
So you did the classic syndication model with your own capital kind of thing, and then growing into making it a real fund. Is that correct?
Somewhat. So the first 3 years when it was my own capital was actually solely my own capital. I started my career in consulting and ended up being a fairly lucrative career. So had the ability to buy homes with my own capital, my wife's money. And then once we got to the point where it's like, okay, it's time to bring in outside capital, we almost had to do it from a fund model, a committed fund model. These homes tend to be on the market at 9 a.m. and then under contract at 12 noon because they're desirable homes in really great areas. So we almost need a discretionary pool to be able to move quickly on each asset. So
there's a reason I said why this vertical is extremely special right now, right? So, and I'll say what I know, and then you'll say that I'm wrong or right. I could be both, right? But there's a thing that happened with interest rates going up is that people, the end consumers, right, could not afford to pay the mortgage. They could not afford to buy a house, right? What was previously fairly easy where interest rates were pretty low. And then what I'm seeing recently happening is that owners, developers are actually they're shifting away from things like, commercial, multifamily, and they're shifting into buying single family homes in a build to rent model. So essentially what they understand is that people are renting more than they're buying right now. And they're actually creating this type of portfolio of single family homes with a really, really professional high-end operations model. Am I correct by saying that? Is that something that you're seeing right now as well?
Yep, it is. It is something that we're seeing as well. And at the end of the day, that's our most likely exit. So for us right now, our tenants are typically renting from us because they are short-termers. So our average tenant moves in when their eldest child is 14 and about to start high school. And they're going to go here for 4 years. So their kids can graduate high school, go off to college, and then they're going to move. They're going to go somewhere else. And if you do the buy versus rent math, 4 years is always cheaper to rent versus buy. So that's why our tenants are interested in this thesis. But to exactly your point, like there is a growing trend here in SFR. And if we do our jobs right, we build a big enough portfolio. We can generate yield for our investors today from those tenants, but if we build a big enough portfolio, we can sell our portfolio to a larger institution who is interested in adding us to their large SFR portfolio, like you mentioned.
So who's your go-to? Who's the company you look up to and you say, okay, this is where I want to be?
So we've got the two that come to mind are actually the same now. So we've got a board of advisors here. We've got a gentleman from Tricon and a gentleman from Blackstone. So a lot of what we do, it's not really the same company since Blackstone bought Tricon, but a lot of what we do and how we think is learned from them, which is learned from those two companies.
Cool. So what's the thesis, right? I know I talked a lot about how to choose multi-assets. I talked about how to choose industrial assets. I talked about retail. Like I've had a bunch of guests here. But what's the thesis for single family rentals? How does that work?
It's a good question, and single family is interesting. The asset class for us is almost a byproduct. So for us, it was actually thinking about it from a zip code level of like, what are the zip codes that we want to be in? And those are ones with really high-end school districts. They've been really high-end for a long time. And then we're looking for areas where owner occupancy rates are 90% or higher. National is about 65%. 90% means there's basically no rentals available, which also means there's no multifamilies available. So we thought zip code first. It's like, okay, if we want to have assets that we rent out in these zip codes, the only real game left in town is single family. So we almost ended up in single family by default rather than choosing single family as an asset class itself.
So essentially you saw the potential of high returns and the demand in the market. So say the demand was for kindergartens, you would probably go for that instead of going for short-term rentals, single family homes. Is that correct? More or less?
I think more or less correct. I mean, for our zip codes, I mean, our average tenant makes $210,000 a year. They're very price agnostic, almost about what they rent. They want to get into the school district for good education. If there are multifamilies available in our zip codes, we probably would look into it, but there are. So we do single family as a result.
Cool. So you said something that was really interesting for me. So essentially what you do is you find the zip codes, you find the really good, most likely you find the really good schools that people want to send their kids to, right? And you say, okay, around this area, where can I find these type of assets? But you also said that the house can go on the market at 9 a.m. and the contract can be signed at 12 p.m. What is your method of underwriting these assets and understanding, do they actually make sense? Because you have such a limited time frame compared to, commercial deals. How do you kind of run that operation?
Yeah, for sure. So there's a couple of different ways that we get homes. For those on-market homes that go very quickly, we build custom software. So it basically sits on top of the MLS. Every home that hits the market gets dumped into it. And because we are building this portfolio for sale down the line to a large institution, it makes it very easy for us, actually, because we've got a pretty specific buy box now. For example, every large institution we talk to wants homes on streets that are 25 mile an hour speed limit or less. They don't want, it's above that, they don't want it. They don't want a house with a pool. They don't want a house with solar panels, minimally 3 bedrooms. There's a list of 17 different things that we have. So basically, home hits the market, it gets run through our software, which checks it against those 17 things. About 10% of homes are remaining after that. And then at which point, me and my team then underwrite those remaining 10%. And that makes it pretty easy for us because it allows us to go through, kind of cut through the noise very quickly, get down to the actual homes that matter, and then spend our time on those homes that matter.
I see it. And then the way that you do it is essentially we have, I assume it's some sort of an AI model, most likely, or something similar to an AI model, or it's just like a checklist type of software. How does that work?
It's closer to more of a checklist type of software. What's interesting is because we're talking about zip codes where there's not a lot of rentals available, in a lot of ways, and many of our zip codes, we almost are the market. We're the only other game in town renting homes in these zip codes. So we use a lot of our own internal data of, hey, we've rented 6 homes in this town in the past year. This is what they rented for. This is the details on the homes, how long it took us to rent them, and allows us to basically underwrite off our own data when we go buy more homes.
Cool. So essentially what you do is you buy the homes, you probably operate them, right? So you have your own operating company, or you work with probably a partner operating company. But essentially what I imagine is, for single family rentals, the family wants a really high-end home, especially when they send their kids to a really nice place. How do you make sure that the assets are maintained to that level when you have probably a large portfolio? Like it could be hundreds of assets simultaneously, and they could be in the same street, but it's like literally different homes. You have to jump through each home and make sure the appliances and everything is kind of maintained and set up to the highest standards. So how does that work?
Yep, you're exactly spot on. Like SFR is an operations business, and it's actually, I would argue, like the hardest real estate business because it's such a heavy operations business. And the most important part of that is data. So for every single home that we own, I have make, model, serial number for everything in that house. And that comes out into so many different facets where we use that data on a day-to-day basis. So for example, if we get a maintenance request from 123 Main Street that the heat's out, Well, when we're sending out the HVAC tech to go fix that house, we're not saying, hey, go to 123 Main Street and like solve the problem. We're saying you're going to 123 Main Street. It's the Lennox 1234 furnace system that was installed 6 years ago. Here's the last 4 maintenance service records for your information. We think it's probably this thing that's wrong with it. Make sure you bring the parts to fix that. That makes it a one-trip maintenance call because the technician doesn't need to go out and diagnose, then go to Home Depot. They're bringing the right stuff with them to solve that issue. It also makes it a lot easier for us on a financial forecasting perspective. We can say, hey, our average age of furnace right now is 2016. So we can say, hey, like we expect based off of useful life, 17 furnaces to blow this year. We expect to be replacing 14 CC units. We expect to be replacing 30 dishwashers. Makes it easier for us to forecast our finances from an FP&A perspective, and get sharp on, hey, this is how much money we brought in. This is how much we need to be holding in escrow for those maintenance events. This is how much we can be sending back out to our investors.
Do you also preemptively send people there to say, hey, this is going to blow. Let's just change this part before it even happens?
We do. So we, every time we have cool. Sent out of the house, like we send a company through to go look at everything. We then make basically repair versus replace decisions based off of the information we're getting back from them.
That's really cool. It's so programmatic. It's like just everything goes into an Excel sheet. I love that. Okay. So we focused on the asset itself. We focused on how you run the homes. Obviously, it's an operation heavy business. And I really like this business, again, because it has the potential to build a really large portfolio for a market that is in need. And I don't see interest rate going down significantly, right, to a point where it was like, I don't know, 4 years ago. So I don't see people moving out of renting. So that's a really cool business model, and I really, really like it. But let's move to the investment side of things, right? So obviously you raise capital for your fund, you deploy that into assets all the time. How's the performance? How's it going to date?
We're doing well. So we're an evergreen rolling fund model. So we basically can bring in capital at any point. And what's cool about us is because we have multi-year leases. So our average lease is a touch under 3 years of initiation, gives us a lot of security in our cash flow planning. So we actually pay out monthly distributions to investors.
Monthly.
They take.
That's really cool.
Yeah, we're pretty unique in that. So investors can either choose to take those distributions, or they can choose to like reinvest them. We have like a drip functionality where you can reinvest your distributions. But those distributions they bounce between 5 to 6% on an annualized basis. And that's with depreciation. So for most investors, that should be 5 to 6% tax free. So it's a pretty solid yield that comes out. And then from an equity perspective, investors also have equity in the fund. And we're up about 6.6%. NAV's sharpened in a month, but we're up about 6% and change over the past 12 months.
Wow, that's really cool. Like finding the right model like that and kind of like focusing on those specific, like it's so beautiful. I really like those models. It's really interesting. And also the idea of rolling back the funds into, I feel like, again, I might be mistaken, so correct me if I'm wrong, but the idea of a monthly distribution is essentially behind the scenes to encourage people to reinvest, because why would they take the money every month? Let's just reinvest, and then we can make a little bit of higher yields, and let's pull out some of the money at least like every quarter or every year, depends on how much cash flow I need as an end LP. Is that a correct assumption?
We honestly, when we were putting together the monthly distributions, the way we were thinking about it was, we think we can, because we've got 3-year leases, we've got just a little bit more security in our finances and what it's going to look like. If we have a pretty high degree of certainty at the end of each month, like this is how much is going to go out to investors, like we might as well just send it out to them. There's no reason for us to hold an ARC account if we can send it to investors. So it was kind of almost by happenstance and really driven by the fact that we've got those multi-year leases. And it's been nice, honestly. For what's ended up happening is most of our investors tend to view us as the high floor, like bond to life equivalent in their real estate portfolio. We have we're very, very, very conservative with our leverage. We don't use it much. So we're basically like the steady, consistent dividend stock. We're like the AT&T stock of investors' portfolios. So we've kind of leaned into that from like a distribution perspective as well.
I really like it. So like what you would say is the ideal investor? Like how much do they invest? Where do they come from? What should they expect when they invest with you?
Yeah, for sure. So we see kind of like two different profiles of investors. The first one kind of uses us as that like balance or like conservative slot. So it could be IRA, family office, higher net worth individual, high income individual. And they go, hey, I'm going to allocate, call it $10 million to real estate this year. I'm going to put $5 million into ground up development. That's going to triple my money and go to zero. And I'll put $5 million into Scholastic, and it's going to just be like my steady Yeti kind of thing. That's cohort number one. Cohort number two is call it like higher income folks who are doctor, lawyer type individual who would be like, hey, I live in a really good school district myself. I get this thesis because I made the decision to live in a good school district myself. I don't have the time to invest in real estate, but if I would have bought homes near me. So I'm going to just put capital into Scholastic because it's what I would have done myself if I had time to invest in real estate personally.
I really like it. That's pretty cool. So, and again, we're going to have this shameless plug in the end. I do have one more question before you plug that in. So we talked about the type of investors. We talked about how you do the monthly distributions. What type of investors, and I think it's a really good for every fund, what type of investors should not invest in your fund? So essentially the ones that are like, they're contemplating, should I invest, should I not invest? Like what people shouldn't do that. And I think again, it's a question we've been having coming, over and over again. So I think it's a good distinction.
I think it's a great question and one that more people should be asking. So I'm really glad you did. And we literally have a slide where it's like, hey, here's who should invest and who shouldn't invest for us. And the ones who shouldn't invest in us are the folks who are looking for the high risk, high return deals. The people who are like, hey, I want to triple my money in 2 years or 3 years in a multifamily reposition. We're not a great fit for. Like we will never beat the returns of a successful multifamily reposition. But I think our odds of going to zero are infinitely lower. And that's those high risk, high return investors are just not a great fit for us and what we're trying to do.
Very cool. I like that. Okay, cool. So we're going into the final piece because, again, every episode I say this, but I promise the audience to stay under 20 minutes. And this is called the shameless plug. So essentially, Sean, this is where you shamelessly plug in anything that you're doing today, any open opportunities that you have, anything that you want to share with the audience. We have GPs, we have LPs that are investing in different funds and different syndications. So this is the opportunity to just talk about what you have going on right now.
Yeah, I mean, so we're never being fund. So we're constantly fundraising and constantly able to bring in capital. So if you are interested in kind of a high floor, good homes, good school districts model, like we're always available at scholasticcapital.com. The other thing that we do that could be of interest is we have called like an open investor update. So we send our investors updates monthly because we have to tell them why the distribution is the amount that it did. But about 2 weeks after we email investors, we actually share that information publicly. A little bit's redacted, for example, like addresses of the houses. But we do have a basically public newsletter where we share everything, what we're doing and the information that we're telling investors. And we've gotten great feedback on that. So if you're interested in following along, you can check that out on the website as well.
Okay, so they can sign up on the website and all the links are going to be obviously in the bio for this episode. So thank you so much, Sean, for joining me today and sharing your valuable insights and experience. It was truly enlightening to just hear your perspective, for the real estate industry, specifically for short single family homes and build to rent. And just your journey within this industry is really interesting, I feel like. To our listeners, thank you for tuning in to another episode of the Dealmakers Podcast. If you enjoyed this episode, be sure to subscribe so you never miss another episode and the latest conversations with industry leaders. If you have any suggestions for future guests or topics, or if you'd like to be a guest yourself, please reach out to us via Agora's website or social media. Stay tuned for more exciting episodes as we continue to explore the stories behind the deals and the people making them happen. I'm Asaf Raz, and we'll see you next time on the Dealmakers Podcast. Sean, thank you so much.